generally sent out within a business day after we've completed this. One thing that's really important to us is to stay connected and then to make sure that we are helping people. And in order to do that, we need some feedback from you. There is a very brief 3-question e-survey shortly after the webinar. Please take the time to fill it out. It is important to us. You can see here just a screenshot that on the bar, which is on most of these screens, is on the bottom. Sometimes it's on the top, but you'll see the Q&A there for asking questions, and then the chat for making comments. Now, before we get into the webinar, let me tell you a little bit about Alan Milner, who I've had the pleasure of being a mentor with since 2016. Alan joined a year before me in 2015. He does power systems design for spacecraft and renewable sources. He is the founder and CFO of Voltaic Systems Startup. I will tell you that my background is not technical, so he'll probably provide a better pronunciation of that. Here's what I will tell you about Alan. He's very bright. He's got a great background technologically, but also has the great ability to put things into plain speak. And I have co-counseled with him, and I have seen him really be effective with people. So he's very knowledgeable. And at this point, I'm going to turn it over to Alan.
Well, thank you, Kate. Hi, I'm Alan. And let's see. I'm going to share my screen now.
Okay, good.
Okay, there we go. So, oops. I'm going to talk about financial statement basics this morning. As I had to learn this stuff myself as CFO of my own company. One of the things that we all find as we start a small business is that we have to do everything. And so picking up new skills is something you have to do along the way. I have to say financial statements are not bad. It's easy to learn, and there are lots of tools. And so we're going to hit the highlights of financial statement basics this morning. What we'll do this morning is first take an overview of bookkeeping, just to talk about how that works. And then what are financial statements, and an overview of which ones are which. Then we're going to look at the 3 basic elements of the financial statements, the income statement, balance sheet, and cash flow. Then a little bit on how you use them and how that can give you indications about how your business is doing. And then we'll sum up. So this morning, we're going to try to take the mystery out of that stuff and give you an understanding of what financial statements are and how to use them. And prepare you to talk to an accountant, if you use one, about how to set up your bookkeeping so that you can make best use of your financial statements. Financial statements are the way you learn how your business is doing. Basically, if you want to control anything, you have to measure it. And the financial statement is your window into the measurements of how your business is doing. So we have to set them up so that they tell us what we want to know. Every business is a little different. Sometimes you'll need to have different kinds of information depending on, for example, whether your business is selling physical items, in which case a sale is either made or not made, or whether it might be services that extend over a period of time. And then you might need to have options in your bookkeeping to do job cost accounting, that kind of thing, which you can talk to your accountant about. But the bookkeeping system is a way that keeps track of all that. And it can also pick up other information besides financial. If you're selling widgets and you want to know how many widgets you're selling in a given period of time, you can have your bookkeeping system keep track of that, for example. Okay, so that's what that's all about. So the financial system is all about transactions. So what's a transaction? Okay, if we sell a product or if we deliver a service, that's a transaction. If we buy something, material, equipment, anything we purchase, if we pay something, payroll, utilities, insurance bills, or if we borrow something, if we have a loan from a bank, for example, each of those is an example of a transaction. The transactions are the input to the bookkeeping system, and the output is the financial statements. One of the most popular systems for bookkeeping is QuickBooks. It's very nice for small businesses. If you have a very small business, a simple Excel spreadsheet will work for your bookkeeping, and it's free to the extent that Excel is free. But the point is, a bookkeeping system like QuickBooks will do automatically things that you would have to do manually in an Excel spreadsheet. So if you have a very small number of transactions, the spreadsheet is fine. But as your business grows, you'll very quickly find that you really want a bookkeeping system. And when you set up the bookkeeping system, you set up a chart of accounts. And you want those accounts to be organized the way you want to use them. Let me give you an example. Suppose your business involves both selling products and selling a service. And maybe when you start off, you're not sure which is going to be most profitable or most important to you. You would want to be able to keep track of your income from those two sources separately, so that you can then look back and say, oh, that product isn't selling at all. I'm making all my money on service. And so I want to reorient my business the appropriate way. That would be an example. Most businesses can benefit from having an accountant to help you set up your accounts the way you want them, and quite often to do your taxes at the end of the year. You may not need an accountant or bookkeeper for the day-to-day stuff. You might be able to do that yourself, but you often want a little bit of help at special times. And it's a good idea to think ahead of time about what you want to know about your business, so that when you sit down with your accountant and he's charging you by the hour, you're not wasting his time. So do your thinking first, and then do that. All right, so the financial statements, the output of the bookkeeping system, are three elements: the income statement, the balance sheet, and the cash flow. And if you get nothing else out of this webinar, this is what you should learn. These are the three elements of financial statements and what each of them does. That's what this is all about. Anything else you get out of this is just great, but at least come away with that. So the income statement talks about how your business is performed over a period of time. When you go into your bookkeeping system, you click the button for income statement report, and it will ask you, what period of time do you want? You can look at it over a year or a quarter or a month, for example. Most people look at their books at least once a month. And they are broken down, the income statement is broken down into revenue and expenses. And at the bottom, it tells you profits or losses. So that's the income statement over, let's say, a fiscal year. What was your income, revenue? What were your expenses? And what were the resulting profits or losses? A balance sheet, on the other hand, is an instant photograph of what your business is doing at a particular time, like, say, the end of the month. And at that instant in time, what are your assets and what are your liabilities? The easiest way to think about this is compare it with your checkbook. One of your assets is cash. And so your checkbook tells you at any given time how much cash you've got in your bank account. But it's a little bit bigger than just your checkbook because it includes other assets such as receivables. If you've delivered a product to a customer, but they haven't paid you for it yet, you have a receivable. Similarly, liabilities. The most obvious one is payables. If I've bought something from a vendor and I haven't paid that vendor yet, then I have a payable and he has a receivable. So that's what payables and receivables are all about. The other examples of assets and liabilities would be loans. If I have a loan from a bank, that's a liability for me. And if I have to then pay interest on it, those are going to be payables. Okay. The third element is cash flow. And while the cash flow is looking backward is important to know to see where did your cash go, it's even more important to look forward and say, where is it going to go in the near future? How much cash do I need to have on hand in order to take care of the bills that are coming in? And this is the most important element of the three for a new business. Because if you run out of cash, you're bankrupt, and that's the end. So cash flow is number one. I would say income statement would be number two, because in terms of profits and losses, it helps you with pricing to figure out what you should charge for your product or service. And the balance sheet would be number three. So this is how they all work together. Transactions are the input, things that happen that affect your finances. That goes into your income statement. That then affects your balance sheet. If you have a profit, your cash is going to go up, and vice versa. And then both the income statement and balance sheet then affect your cash flow. So this is the way the information flows through your bookkeeping system. So they all function together, and they each show a different picture of your company, but they're not independent. It turns out that if you have any two of them, you can derive the third one by adding and subtracting things. They may look complicated, but the basics are not complicated, and this is going to be easy for you to understand. So here's a great chart that summarizes exactly what you'd like to carry away from this webinar about these elements of the financial statements. The income statement is talking about revenue and expenses, profit and loss. And by looking at that, you can figure out things like what's your break-even level of business. In other words, how much business do you need to do in order to just barely make it without any profit or any loss? That's the minimum business you need to be doing. You need this after a period of time, like a quarter or a year. It tells you whether you're making money, so it lets you adjust your pricing. It's not as urgent as the cash flow. The balance sheet is all about assets and liabilities. Assets include cash, receivables, inventory, and equipment. Liabilities include payables, loans, or any kind of deposits. By looking at the balance sheet, the difference between the assets and liabilities is the equity value of your company. So each time, each individual time that you look, you'll see a slightly different value in there as your company makes money or loses money. So you need to know what you have on your balance sheet. And you can compare your balance sheet for, let's say, this month with last month or with the same month a year ago to see how things have changed. The cash flow is the most urgent. It tells you how much cash you have on hand, how it's changed looking backward, and looking forward. When you do an estimate of your forward cash flow, that's called a pro forma, meaning before it happens. And this tells you what the cash is going to do in your business. That's the most important thing in keeping your business alive. By knowing what the cash flow is going to do in advance, it gives you choices. You can make decisions about what to do. You can sell things, buy things, or you can choose not to spend money if you find your cash is getting short. Okay, so those are the three elements, and that's what I'd like you to remember from all this. So let's look at each one separately. First, the income statement. Okay, the top line of the income statement is revenue, income, sales. That's usually the basis. If you want to do things on a percentage basis, you take everything as a percentage of revenue. You can then adjust that. You'll see some minor adjustments, but basically that's the revenue. Then you want to subtract off the cost of sales to get your gross margin. The cost of sales are what we call direct costs. They're all the things that go up and down depending on how much business you're doing. So if I'm selling widgets and I make a widget out of 2 pieces, the cost of those pieces is a direct cost. If I sell more widgets, I'll have to buy more pieces. That includes material and also direct labor and overhead. If somebody is putting those 2 pieces together to make a widget that I can sell, that labor is direct labor. That would be part of the cost of sales. Similarly, overhead, if I have to provide vacation benefits for that person, that would be part of my direct labor. That would be the overhead for it. Any benefits that I have to provide for that direct labor would be examples of overhead. And when you subtract the revenue minus the cost of sales, you get the gross margin. This is how much money you've made directly on selling that widget. It's not your profit. And that's why I prefer to call it gross margin rather than gross profit, because you have fixed expenses that you have to pay for before you get to profit. And we'll see those in the next slide. But gross margin is a very good measure of how your business is going. If you look at publicly traded companies online, one of the things they will see, they'll tell you their sales and they'll tell you their gross margin. A good number for gross margin might be something like 40% for a good, healthy business. But every business is different. Grocery stores, for example, run on a much thinner margin than many other businesses. Once you have the gross margin, then you have to subtract off the fixed expenses, the indirect expenses. Now, these would be examples of these would be rent, utilities, the salary of people who are running the office. You have to pay them even if you don't have any business that month. So those are indirect expenses. When you subtract those off of the gross margin, you get the profit from operations. There are some minor adjustments having to do with depreciation and other special expenses. Banks are very interested in those adjustments, but for us running the business, basically the indirect expenses subtracted off the gross margin gives you the profit. And so the bottom line is the net profit or loss. And that's the bottom line. Okay, if you have questions about these, please put them into the question and answer, and Kate will pass them on to me.
Alan, it's
Yeah.
Kate. If I could just jump in for a second. In the chat section, somebody suggested terminology with definitions might be helpful. An example, liquidity overhead. So with that in mind, do you have a cheat sheet, if you will, of this? Or any suggestions on where one might find one, or can we put something together?
Well, if when I believe people are going to get a copy of the slides
Mhm.
from this presentation, and you'll see in the slides that I'm presenting, as well as in the extra slides at the end, you'll see definitions of a lot of these terms.
Terrific. Thank you very much.
I think that's a good place. Other than that, I would say find a good book on small business finance, and they would have lots of definitions in there.
All right. But it's good to know that there's going to be some resource at the end of this. So great.
Okay.
Thank you.
You'll see as we go through, like for example, in this slide, one of the things that the banks like to look at are earnings before interest, taxes, depreciation, and amortization. EBITDA, however you want to pronounce that. Here's a good place where you could see a definition of that term. So I think you'll see these things as we go through.
Okay. And then one other thing you asked, and they have responded with some questions. Do you want to take those now or wait till the end?
Let's take a few now. And
Okay. So first one is, how does depreciation work?
Okay. Let's suppose I have a carpentry business and I'm operating out of a truck. So I've bought the truck. I paid, I don't know, $20,000 for my truck. And then over some period of time, the truck's going to wear out. So I want my books to reflect the fact that I've got this ongoing expense, essentially, of the truck wearing out, even though I may not be paying more cash for it. But I'm going to have to replace the truck eventually. So there are schedules for various kinds of equipment, like a truck, and over a certain period of years, you depreciate the value of the truck. Suppose the truck had, I don't know the rule for trucks, but suppose it had a 5-year life and I paid $20,000 for it. So I could essentially take $4,000 a year of expense for depreciation on the truck. And that can be, that's a tax deduction. So it's important. It's not an immediate cash expense, but that's how it works. And so your accountant can help you with depreciation. Basically, you want somebody who understands the tax regulations to figure out how to do that. You can't just make it up. But it's not complicated. I hope that answered that question.
Okay. Then next one is, where or how do, and this is in quote, return products get classified?
Well, the answer is I'm not entirely sure.
Okay.
I could guess that would be an expense and would come out of direct expenses. But I think that would be a good question for an accountant.
Okay. One more, where would a deposit from a customer fall on the balance sheet? That is a deposit they gave us before we start a service project.
Okay, good question. All right, let's say I'm a solar installer and I get a deposit of $2,000 from my customer before I do anything about the job. Okay, so I have an asset, cash, of $2,000, and I have a liability because that is a deposit and I don't really own it yet until I've done the job. So I have a liability of $2,000. When I finish the job and close the job, then that deposit, that liability will go away because I finished the job. But for example, let's say I'm charging $20,000 for the whole job, but I had a liability of 2,000 because I already had taken that deposit. So that's how that would all work together.
Okay.
Uh,
Uh, is a warranty and or non-warranty, is that a cost? If I'm asking that question correctly.
Okay. Depending on the business that you're in, you may want to have some kind of an account to cover future warranty costs. And so you would carry a liability for future warranty expenses on your books. Some people choose to do that, others don't. But if you don't, then you could get an unpleasant surprise if you have a whole bunch of warranty calls. So that's another one to discuss when setting up your books.
Okay. Going back to the depreciation example that you gave about the truck, the asset of the truck on the balance sheet would then be $4,000 lower, correct?
Right. Each year you would have to reduce the value of the truck by that amount.
Okay. And one final question, what are the quick measures to look into to see if the company is healthy or not? And if the company is headed towards bankruptcy?
Okay. We will talk about that later. Um, when you talk about assets and liabilities, you can talk about current assets and current liabilities. Uh, Typically, by convention, through the normal standards for bookkeeping, any asset or liability that can be turned into cash within a year is considered current. So, for example, if I have a receivable that I expect to be paid next month, that's a current asset. If I have a bill that has to be paid next month, that's a current liability. If you take your current assets, which includes your cash and your near-term receivables, and you subtract your current liabilities, you get a number. And if that number is positive, then you're in good shape. If it's negative, then that's not good shape. That's called your working capital. All right. You can also take the ratio of current assets to liabilities. And if that ratio is bigger than 1, that's healthy. If it's less than 1, then that's not good because it means you've got to do something or you're going to be bankrupt within the year. Something has to change. So that's a quick example. Another example was the break-even revenue level that we talked about earlier. And I'll try to get to those a little later in the talk if we have time.
Okay. One more question that we have here. When setting up bookkeeping, how specific should categories be? For example, utilities is a simple to understand category, but supplies needed to make a product or to run the business are not so straightforward. So how specific should categories be?
Okay, well, I guess the answer is they have to be specific enough that you know where to put each item, or your bookkeeper needs to know where to put each item. Some categories, as you mentioned, like utilities, are pretty simple. Some can be complicated, like inventory. Okay, inventory is material that you've got that you plan to sell later. Now, suppose I build up some inventory and then I change what I'm doing. I come up with a new model or something, and I'm not using that inventory anymore. I've made it obsolete. I better do something to reduce the value of that inventory because I can't sell it the way I'm going. So the treatment of the value of inventory is a little tricky if you're in a business where those kinds of things can.
Okay.
So I guess the answer is what do you want to know about your business? And do you have your chart of accounts detailed enough to be able to learn what you want to know? And that's the discussion to have with your accountant when you're setting up the chart of accounts.
All right, that's it for questions right now. Thank you.
Okay, well, thank you all, and keep those questions coming. Okay, so things to think about. If your income's broken into jobs, let's suppose a typical job lasts 6 months. You have to be careful, because if somebody pays, well, if you have all the expenses for a job this month, but you're not going to be paid for it until next month, your income statement for the month is going to show a big loss, because you bought all this stuff and you've paid all these expenses and you haven't got the income yet. Or the other way around, if you've got a deposit, if somebody has paid you for something in advance and you haven't delivered it yet, and maybe you haven't incurred all the expenses of making it yet, that's going to distort things. So in order to avoid distorting your income statement, some people use what they call job cost accounting, where you essentially hold things in an account like inventory or something until the job is finished. And then you recognize all the income and all the expenses for that job when the job is done. And for example, in QuickBooks, you can buy an extra module to let you do that sort of thing if that's the kind of business you're in. So that's a good discussion to have with your accountant when you're setting up QuickBooks. Okay, here's an example of an income statement. This particular company had $55,000 in sales, and as I said, there are a few adjustments to get net revenue. That's not usually a big deal for most businesses, but it's something to keep in mind. And then off of that, you subtract your direct costs: material, labor, benefits, which is overhead. So let's say there's $50,000 in direct revenue and $30,000 in direct costs. So you have a gross margin of $20,000. It's nice to show this as a percentage of sales. So if the cost of goods was 60% of the revenue, then you have a gross margin of 40%. That's a good, healthy business with 40% gross margin. Then you have your indirect expenses, your fixed expenses, and you can see examples of them here. So this particular one had $13,500 in total fixed expenses, which was 27%, leaving profit from operations of 13%. Then there's some adjustments like interest and depreciation. So the real profit, one you care about, is 10%. That's another example of a good, healthy business with a 10% profit margin. More is better, but if you can make 10%, you're doing pretty well. Okay, so there's an example of your income statement. Now, think about what kinds of things you want to know from your income statement. For instance, sales. Do you have more than one kind of sales? Do you want to be able to separate them? In that case, you want to have separate accounts for the different kinds of sales. Cost of goods sold, that's the COGS acronym. How do you want to split them out? Do you want to see the difference between your material and your labor? Are there other categories that you want to do? What indirect expenses do you expect to have? So think about that. You might want to scribble down just what the categories you would like to see in your income statement, so that when your accountant sets it up for you, those are easily visible. Now here's an example of an income statement spread out over a year. You would fill in each month as that month occurs. So here you see the example. And you see that many things are constant, especially the indirect expenses across many months. They may not change at all. On the other hand, the direct material and labor would change because the sales go up and down. And you can see that in most businesses, the sales start fairly small, and you're not breaking even. So your profit is negative. You have a loss. And then as you build up the business, it becomes positive and you earn the money back, and then you start earning an overall profit for the year. So there's a good example for you. Let's talk about taxes a little bit. In a sole proprietorship, the owner is the taxpayer. And so it all goes on your Schedule C of your personal income tax return. In a partnership, you divide the income and expenses from the business, and you have a schedule to divide that up. An S Corp or an LLC is pretty much the same way. The owners are the taxpayers. So creating an LLC doesn't really change your taxes. It just shows up slightly differently in when you do your year-end taxes, but you're still paying as if it were your personal income. On the other hand, in a C corporation is a legal entity all by itself, and it pays its own taxes. And then anything that gets passed from the corporation to you has to be taxed as a dividend. And that's what's called double taxation. That's a reason not to have a C corporation unless you've got a good reason to. If, for example, you plan to sell stock in the company, then you'll need a C corporation. So that's something you can discuss with a SCORE mentor when you set up your business. Okay, let's move on to the balance sheet. The balance sheet, remember, was a snapshot of your assets and liabilities at a given instant in time, usually at the end of some kind of a period, like a month or a year. Cash, that's your bank balance. Accounts receivable, what the customers owe you. Inventory, things that you've put on the shelf that you own, they have value, but you haven't sold them yet. And you have to follow the rules for how you figure out what they're worth. Then you have longer term assets, property, plant, and equipment, or investments that you've made. And then intellectual property, a patent, for example, or a copyright. You have to figure out what those are worth. Be very careful, because can they be sold? Can you turn them into cash? So don't go crazy with figuring out what the intellectual property is worth. You may want to talk to your accountant about that. Okay, then the other half of the balance sheet, liabilities. Accounts payable, what you owe your suppliers. Debt, what you owe your lenders. And if part of it has to be paid within a year, you want that to be categorized as current liability, as opposed to a longer term. Suppose you have a bank loan that might not be due for 10 years. That's a long-term debt. The difference between the assets and liabilities is the shareholder's equity. Now that can be divided into two parts. Capital stock, suppose you put $1,000 into your business to get it started, that would be considered capital stock. And retained earnings, which is profits that haven't been paid out but kept in the company. The combination of those two represents the shareholder's equity. So as you make more profit, your capital stock won't change, but your retained earnings will go up. And so the shareholder's equity would increase. So here's an example of a balance sheet.
Alan, if we could just go back to the previous slide for one quick second.
Sure.
Question came up, what's a shareholder distribution versus the shareholder payroll?
Okay, there are two ways to take money out of your company. One would be for you to be an employee, in which case you would be on the payroll and you would be paid for your time. It's essentially taking money out of one pocket and putting it into another because you own the company. But there are some advantages to doing that. And there are advantages to not doing that. If you do that, you have to have withholdings for Social Security and taxes. And on the other hand, if you just keep the money and don't pay it to yourself as a payroll, you don't have to do those things. On the other, shareholders' equity, let's see. Well, the other way to take money out of the company would be as a dividend. At the end of the year, you see you've made a big profit, you've got a lot of money in the bank account, and you can just pay it to yourself, and that would be called a dividend. So that's the two ways of getting money out of the company. Did that answer the question?
I believe so. If not, I'm sure they'll come back and ask something more,
Okay, so let's keep going and
please.
look at the example of our balance sheet. Okay, this particular company has $100,000 in assets. It has cash, accounts receivable, inventory, and plant and equipment. Okay, then it has liabilities, accounts payable, accrued payroll, things that you owe to your employees, and bank debt. Okay, the bank debt and the PP&E would be examples of long-term assets and liabilities, and the others would be short-term. Then that, so that the difference between that, between your total liabilities and your total assets is your equity. And the total of equity and liabilities is always equal to the assets. Accountants love to have two columns that add up to the same thing. So that's basically the format that this is generally put in. And the equity, the value of the company is a combination of the owner's investment and the accumulated profits, as we talked about earlier. So there's your balance sheet. Here's where and when I was answering the question earlier, current versus long-term assets and liabilities. The rule is 1 year. If you have to convert, if you're going to convert something into cash within a year, that includes accounts receivable and inventory, then it's a current asset. And if it's going to be, if a liability is going to be paid within a year, then it's a current liabilities. The working capital is the difference between the two. The idea would be to keep the working capital positive if you can, because within a year, you're going to need the cash to pay those things. You can also take the ratio of current assets to liabilities. That's called the current ratio. And if that ratio is better than 1, you're in good shape. Just two different ways of saying the same thing.
Hey, Alan, just going back to when you're talking about the dividends and all that, is a dividend taxed? Somebody asked.
Well, if the company makes a profit, that profit is going to be taxed.
Okay.
If you keep the money in the company, that's fine. The company can pay the tax. If you take it out as a dividend, then you put it in your bank account. It's still the same tax is still going to need to be paid. It's just that you might need to pay it out of your bank account because you've taken all the cash out of the company.
Got it.
Okay.
Got it. Thank you.
All right. Let's talk about, okay, so think ahead of time about what you would like to see in your balance sheet. You're certainly going to want to see cash. You should see accounts receivable. And think about how are you going to use your cash? If you allow your customers lots of time to pay their bills, you're essentially acting as their bank. You're lending them money for that time. Do you have enough cash to be able to do that? So you can make decisions about what kind of credit you're going to allow your customers. If you're going to have inventory can eat up your cash because you've paid for things, put them on the shelf and haven't sold them yet. Certain kinds of businesses, like clothing businesses, are famous for eating up cash with inventory. So be very careful with that. Property, plant, and equipment is long-term assets. They're long-term investments that you're making. If you buy that truck, you're expecting to keep that truck for a good bit of its life. And so you're going to be tying up your cash in that way. Same thing with liabilities. If you pay all your bills the day they come in, your suppliers will love you, but you'll be eating up your cash. So maybe you want to pay as slowly as possible, depending on how much cash your business has. So you need to think about that. Payroll. Are you going to have employees? How are you going to pay them? If you want, there are many services available out there to handle the payroll for you. They'll take care of deductions for Social Security and taxes and so on. Or you can do it yourself. But of course, all these things cost money. Are you going to have loans? Will you have a fixed loan, or would you have a line of credit from a bank that you can draw on as you need it? Are you going to have loans from other people? So that's all things to think about, because they're all going to have to show up on your balance sheet. Now, cash flow, the most important element. Cash in and cash out. All the things in the cash flow relate to the income statement and balance sheet, but cash has a special importance because if you run out of it, you're bankrupt. So there are three kinds of cash flow: cash from operations, from doing your business, cash from investment activities or bank interest, and cash from financing. If I take out a bank loan, I get cash. It has nothing to do with the operation of my business. Okay, so the bottom line is the change in cash. A business can be profitable and still run out of cash. Here's the example I was giving earlier, clothing businesses. You may be selling lots and lots of clothing, but if you've got lots of it sitting on the shelf, it might eat up all your cash and you could go bankrupt even though you're making a good profit. So be careful. So here are each of those three components to look at in a little bit of detail. The cash from operations, and this is just showing how to calculate it. Your bookkeeper or accountant will take, or your bookkeeping system will take care of this for you. The cash from investment activities. I might, for example, put the cash in an interest-bearing bank account and I'm getting interest from that, even if I'm not doing any business. So it has nothing to do with my operations. And then financing, as we said, if I take out a loan, that doesn't have anything to do with my operations per se, but it definitely affects my cash. So here's an example of how you could calculate the cash flow from the income statement and balance sheet. And you can see how each of the elements, inventory, purchases, will affect your cash flow. But quite frankly, although this shows how they all tie together, this is not the way you use a cash flow. So I'm going to move forward. There's another example of a less beneficial cash flow. Here's a cash flow spreadsheet. This would be filled out because you're really interested in learning what the cash is going to be in the future, not just in the past. So even before you start a business, you would do a pro forma cash flow. You would take a sheet like this. This is a template that's available from SCORE, and you would fill it out at least for the first year. If you're going to get a bank loan, they're going to ask you to estimate it for 3 years. Now, you usually have a pretty good idea of what your cash flow will be for a year in advance because you have some idea what you expect your business to do. The second year is an estimate. The third year is probably a wild guess. Very few of us can really predict 3 years in advance what our cash flow would be. I mean, think about the state of Massachusetts. 3 years ago, could they have predicted their cash flow during the COVID epidemic? Things happen. But just the same, people want to see what you expect the cash flow to be because it gives them some insight into what your plans are for the business and what kinds of things they can expect a couple of years down the line. So take a look at this. The nice thing about these cash flow templates is that they have lots of categories for expenses. You might not have thought about advertising or utilities or telephone when you're making your estimate of how your business is going to go. So this is a way of reminding yourself of all those little expenses. So I recommend using one of these cash flow templates when you're doing your pro forma cash flow, your estimates for the future of what your cash flow will be. This template will automatically take the cash at the beginning of the month and then subtract and then add in cash that would come in during the month, subtract cash that would be paid out, and calculate the cash at the end of the month. It would then copy it over to the next month and do it all over again. Many of the lines on this cash flow spreadsheet will be constant all the way across. Rent, for example, is usually the same every month. So you can just do copy and paste and very quickly fill this out with what you expect your expenses to be. On the other hand, something like sales or purchases, which vary depending on how much business you're doing, when you start out, you may have a fairly low level of business, and then as the year goes on, that might increase. So you want to think about how that increases as you go across. Down the bottom, you'll see some lines that aren't really part of the cash flow, but simply are things that you want to keep track of each month, like, for example, the number of widgets you're selling or the number of customers that you have. And that's fine. It's a good place to keep that stuff. But the cash flow is essentially the part that you can see on the screen right now. Okay, so that's your cash flow, and that's the most important single element of the financial statements. Do we have other questions at this point?
Yeah, and this one actually goes back to when we were talking about tax on the dividend. I believe it's a she said, I know the company pays the tax, but then do I pay a personal tax? Just a little confused on that.
Okay, yes. If you are in an LLC or an S corporation or a partnership, you are the company. It's one financial element. You put in one tax return. It would have a Schedule C or Schedule K or something for the company's part of it, but it's essentially all income, and you pay on it as personal income tax.
Okay.
There is no additional tax. So creating a company doesn't create a double tax situation. On the other hand, if you have a C corporation, one that's able to sell stock to the public, that is an entity in itself. It files its own tax return, and then you get the double tax situation. The company pays tax on profits, and then if it pays you a dividend, you have to pay a tax on that as well. Clear?
I hope so. They'll let us know if it isn't. And that would perhaps lead to a question that came up earlier, which was why would you choose an S Corp versus a C Corp, which I think you've kind of alluded to with your recent answer. But
the S Corp, an LLC and an S Corp are very similar. They have a slightly different tax treatment. The difference is so subtle that you would need to talk to your accountant to figure out whether you want to do it. The S Corp gives you a very slight tax advantage under some circumstances, but it's not much. On the other hand, a C Corp is a different animal. It's set up in order to be able to sell stock, and the taxing situation, as I just described, is quite different. So a C Corp versus an S Corp, different animals.
okay. And then somebody said, do you recommend having more than one business bank account?
In general, the answer I think would be no. But if you had different parts of your business, let me give you an example where you might. Suppose I have a business and I'm doing, let's say, web services. And then I decide to set up a certain part of the business where it's kind of a joint venture with somebody who does marketing. and you're working together, you're sharing parts of the business. But maybe you want to keep track of the different parts of the business separately so you can figure out what you owe each other. Then you might want to have separate bank accounts. Other than that, I can't think why you would want to have multiple bank accounts. I suppose you could imagine a business that was, well, for example, suppose I was doing some overseas business in Europe and I needed to pay bills in Europe and take payments in Europe. I might need to have a European bank account to handle that stuff, but it would be for special circumstances like that. For simplicity, if it's all domestic within the US and you don't have to split things up with somebody, for simplicity, I would have just one bank account.
Okay. And this comes from the comments. As a new treasurer, how do I confirm 990 history for my organization?
Okay, as a new treasurer, I would say, how confident are you that the past records are accurate? How confident are you that that there haven't been mistakes or improper payments made? So as you're inheriting responsibility for this, you need to take a look at the books and see whether you trust them. If there's any question about that, you might want to have an audit. You might want to call in an auditor and pay an outside third party, disinterested party, to look at the books with their expertise and say, yes, the books are okay, you're fine to take it over from now. So that would be something to think about.
They've then asked, how can I confirm history of Massachusetts annual report filings?
Well, I believe the filings with the state are public documents, and you can get copies of them.
Okay.
Contact the Galvin's office, the Secretary of Massachusetts, and see what you have to do in order to get copies.
Okay.
Same thing probably with the IRS. I'm not sure. As we know, some people's IRS statements are not public, but companies generally are.
All righty. And we just had a question come in. What % of revenue should small businesses set aside for taxes?
It's a good question. If you're a small business like an LLC, you're basically paying the tax at the same rate as if you were an individual. So depending on your income level, you should set aside that percentage that would be appropriate for your level of income. It would be whatever your personal income tax rate is.
Okay. I don't see any other questions, Alan. I will just point out that a woman named Jill Goldman just sent a website address and how you can look up corporate filings. So that to everybody, so you have access to that.
Oh, good. Thank you.
Thank you, Jill. And so, yeah, that's it, Alan. And if you would like to wrap up, that would be great.
Okay. So we're just going to talk a little bit more about cash flow. Most small businesses struggle with cash flow. If you're not struggling to have enough cash, you're really lucky. So you want to watch that very often, even week by week, you might want to, but certainly monthly. And if you expect a shortfall of cash, you have to address that in advance. If you fill out your pro forma cash flow for a year in advance, take a look at the lowest point in your cash flow. That's how much cash you need to start the business. And you need to figure out where that cash is going to come from. And that includes taking care of your tax obligations. Okay? So then let's talk about some of the things that you can do with your financial statements to understand how the business is doing. You can compare things from one period to another. Here's an example of comparing your current income statement with the previous year. Take a look at the big numbers. Take a look at what's gone up and what's gone down and at the percentage of sales and see, are things getting better or worse? And if so, why? Do you understand why? And what do you have to do to improve it? The balance sheet, comparing that from year to year or from month to month. The example here shows bank debt came down. That's good. What other changes? Inventory went up. Did I intend for inventory to go up? Was that on purpose, or did that just happen accidentally? So take a look at the comparisons. You can also look at it this way. What are the uses and sources of funds? Where did the money go? And where did the money come from? This is a useful way to take a look at this. Okay, so that's basically what I wanted to give you today. The important thing about the financial statements is it lets you see where you've gone and where you're going. I like this quote from Lewis Carroll. If you don't know where you're going, any road will take you there. So pick your road.
Hey, Alan, just one last question. Does QuickBooks have a cash flow report that automatically generates?
I'm not sure that it does.
Yeah.
I've looked for that and not found it. So you might want to talk to your accountant about how to generate one of those. The main thing about cash flow is you want to know what it's going to be in the future, and QuickBooks can't generate that for you. You've got to do that yourself. So using a cash flow spreadsheet template is a good idea. But it's a good question, and I'm not enough of a financial expert to be able to answer that.
Okay. So here's a question. We started a new business and all bills are paid by one of the LLC members, and the other two members write that person a check out of their personal accounts. We're now starting to use QuickBooks. How do we record that in QuickBooks? We want to show we invested money in the business.
Okay. You can talk about whether that's going to be a payment or a loan. It could be either way. If it's a payment, then it's paid in capital by one of the owners and goes into paid in capital. And if it's a loan, then it shows as a liability because it has to be paid back. Does that answer it?
Hope so.
Okay.
Somebody asked a question, can SCORE help me find an accountant? And I can certainly address that, Alan. We have a list. First off, we're not in the business of referring to specific businesses. However, we can certainly guide you in what are the things that you want to specifically look at, in looking for an accountant and get a little bit better prepared in interviewing them to see who you feel most comfortable with. We do have a list of various vendors within different categories that we can provide to you. So I hope that answers the question.
Yeah, to be a little more specific on that, SCORE doesn't make individual recommendations of this is one accountant that we recommend for you, because that could possibly lead to a conflict of interest on our part.
Yeah.
Instead, we'll give you a list of a number of accountants or bookkeepers or lawyers or whatever you're looking for, who are people that have had a good interaction with us or our clients in the past. But it would always be a list of more than one. And that's how we avoid the conflict of interest problem. So you can ask your mentor to give you a list of, for example, accountants, and they can give you that short list.
We just put up the questionnaire relative to this webinar, so I hope you would take the time to fill it out. And before that popped up, and while you're filling that out, the question came up about does SCORE have any accountants we certainly that can help us. We have a number of mentors with financial background and accounting background, understanding that they can help guide you through the process. And please understand, we don't do the work, but can guide you on how to do the work.
Right, and similarly, we have counselors who are lawyers, but as they would explain, they're not your lawyer, even though they're a lawyer. In other words, they can help you think about legal problems and they can help you find a lawyer, but they're not going to do your legal work for you.
Exactly.
And I'm going to interrupt real quickly, and I did put it in chat. Please know that there is a QuickBooks webinar coming up. If you want to check out the SCORE Boston's workshop page, it will be a 3-part series. We will be doing one day devoted to the QuickBooks desktop version and another day devoted to the QuickBooks online version. But the first one for the QuickBooks overview is posted, and you can register for that now.
Okay.
Okay, and by the way, if you want to schedule a mentoring session with one of our people who is, has an accounting background, quite often they can give you a tutorial on QuickBooks. So that can work out quite well.
Great. All right.
Okay.
I
think we're all set.
Yeah. All right. Well, I want to thank everybody today for joining us. I want to thank Alan and Kate for giving the presentation, or giving the presentation and assisting with the presentation. And everyone have a good day. And please feel free to reach out to SCORE if you have any further questions.
All righty.
Thank you.
Thank you.